Good morning, everyone. My name is Michael Naidrich. I am the co-CEO of AmeriVet Securities, and I have the good pleasure, as always, to be joined by my partner, all things Fed rates and liquidity, Gregory Faranello. And we have our first three-peat guest here today, Greg. Subadra is with us today. As you all know, Subadra is from Société Generale, where she is the head of rates, head of U.S. rates and strategy. Subadra, first of all, thank you so much for coming back again. We're most appreciative, very kind and generous of you. And Greg, bud, I say this a lot lately, but I'm going to say it again. All eyes are on the Fed. Quarter point, no quarter point. Personally, I think more than ever, this is more about whether it's pause versus pivot and what they say after. I think the quarter point or not doesn't almost matter on a relative. But that being said, my mom taught me well, leave it to the people that are much smarter than me. So Greg, I pass it over to you and Subadra.
Good morning, Michael, and good morning, Subadra. It's great to have you on for a third time. You know how we like to do it here. We like to dive right into it. And I've got some buckets laid out that I'd love for you to share your ideas with us and with our clients. And I'd love to start with the meeting in and of itself. We kind of know where we're priced, what your thoughts are in terms of decision, obviously the statement, and then the press conference with Chair Powell. It certainly is lining up to be, I think, one of the more consequential meetings in a long time.
Thank you, Greg. Thank you, Michael. I completely agree with you. I think this is going to be a very consequential meeting, not because of the changes to the statement, but what Chair Powell says in the press conference. I think broadly speaking, given the outlook for inflation, as well as the broader fundamentals in the economy still being relatively strong, I think the bias is going to be towards perhaps tightening. I don't see them saying in the statement that they're going to shift the balance of risks or point to any sort of a pause or a pivot. They're going to probably keep their optionality open to tighten further if needed. But at the press conference, I think Chair Powell is going to get a lot of questions, not just on inflation and the fact that super core inflation has been quite sticky, but also on what's happening on the banking front and on financial stability, given the recent developments on SVB, as well as the report that they put out on Friday.
It is interesting, and that's an interesting take, I think, in general, because there is a contingent of market participants out there that think the Fed could hike 25 and actually pause. With that, I guess when you look at the data from last week, you look at ECI, you look at PCE. To your point, certainly the inflationary dynamics are still very, very sticky. With that, I'd love to get your thoughts on the economy in general, on inflation in general, and maybe with a little bit of flavor for what's going on in the banking sector right now and how that could potentially spill over to the broader real economy.
To be clear, our view is that the Fed gets to 5 to 5.25%, one more 25 basis point rate hike, and then pauses. I'm just suggesting that the Fed won't be forthcoming about telling or advertising that to the markets. But broadly speaking, you're absolutely right, Greg. The ECI print that we got last week was, showed that wages are running around 5%. That's still relatively hot. Your services side inflation is still pretty high. The super core, which is what the Fed looks at outside of shelter costs, that's still running relatively hot. Shelter costs should start to moderate in the second half, but you're really not seeing much in the data now that would suggest a meaningful moderation of a broad variety of metrics on inflation. And then with that, add to the backdrop that the labor market is still relatively strong. We get an employment print on Friday. It's a busy data week. Our economists are actually have an above consensus expectation for employment at around 280,000. So the employment picture is still relatively strong. So in that sort of context, I don't see the Fed really suggesting a meaningful pause or a pivot. The banking situation, of course, is something that we're monitoring very closely and is adding to the volatility in the markets. Broadly speaking, the Fed is concerned about financial stability. We saw some good positive headlines on First Republic versus JP Morgan over the weekend that should stabilize financial conditions. But broadly speaking, that's an area that the Fed's going to continue to stay focused on. There are long and variable lags between policy and the transmission mechanism into the broader economy. Given financial stability concerns, I think the Fed's going to take a much more cautious approach, if you will, on the policy front.
So let's run with that. Let's run with that a little bit in terms of market pricing, market structure. Obviously, we look at follow the 2-year note very closely here. Not too long ago, we were above 5%, came down very quickly in March, down to 350. It's almost like we had a rate easing cycle within a couple of weeks. What's your view relative to Chair Powell potentially not signaling that pause? What's your view on the rate structure here? What's your view on the forward curve? Obviously, we have rate cuts priced in for 2023, and then more broadly speaking, what are your thoughts on yield curve shape?
Yeah, I know those are all very good questions. The front end is going to be pegged to Fed expectations. I think the long end could see those flight to quality flows that we've been seeing over the last several weeks. The Fed is probably going to be on hold for the remainder of the year. So cuts being priced in the second half, in our view, is a bit premature. We do have an inflation penciled in for early 2024, which is when we see the Fed starting to cut rates. But by and large, we don't get an update to the summary of economic projections at this meeting. The Fed thinks that they're probably going to reduce rates by about 75 basis points in 2024 and by 200 basis points by 2025. So in our view, if there is a recession in early 2024, then the Fed's going to have to be a little bit more aggressive on rate cuts next year. That said, I don't see them getting past the neutral rate of 2.5% anytime, at least in the first half of next year. So the rate cut path is going to be, pretty benign. The forwards are pricing in for a steeper curve, which I think makes sense. So expecting the curve to steepen beyond what the forwards are pricing in is going to be a little bit more challenging. But that said, I think the curve should continue to gradually steepen as we shift towards a policy tightening bias to a policy easing bias over the upcoming year.
Yeah, no, that certainly makes sense, and I appreciate that. I want to sort of end with one bucket here, and I almost apologize by asking it because it's not my favorite topic, and I know we're not politicians down in Washington, D.C. We're market participants. But I think certainly with a number of client conversations I've had of late, the debt ceiling continues to come up here. And I think relative to other periods that you and I have both lived through, where things were a little contentious, I think certainly the level of where we're at right now seems to be somewhat equivalent to that. So I'd love to hear your thoughts really generically in terms of what you think about the dynamics right now and maybe some of the short-term dynamics in terms of what we're seeing in the T-bill curve.
Yeah, no, I think the political brinkmanship you're seeing, Greg, right now, as we've experienced in the past, seems very much more in line with what we saw back in 2011 and 2013, when we saw this sort of downgrade from the S&P and the potential for getting down to the wire and a technical default. That's definitely playing out in the bond market. You're seeing the cheapening of the bill curve, especially in the 3 to 4 month sector. You're seeing that area where the market is expecting sort of the debt ceiling deadline, or what we call the X date, which we have penciled in for late July, early August. So bills around that time frame are cheap on the curve. You are seeing 1-year and 5-year sovereign CDS on the US start to price in a higher cost of protecting for defaults. Even the FRN market, which tends to be not very reactive, you're starting to see that mid-July FRNs are starting to cheapen up. So it's definitely playing out in the bond market. And broadly speaking, I think that there are jitters that you're seeing, but it's not really that apparent in the equity market or the credit markets in the same fashion. And I think that will happen closer to when we get to the X date. For now, we're focused on the negotiations. We don't have a clear idea of what the X date is from the Treasury. We will be looking to get clarity on that. But our expectation is that late July, early August is when the real deadline for the debt ceiling comes into play. And that's really when I think things are going to start heating up in the summer. So buckle up for that.
It's certainly, I appreciate that. And it's certainly going to be an interesting couple of months. It's a little frustrating that we have to go through these periods of time every year or 2 years and keep kicking the can down the curve, but certainly worthwhile, I think, when we look at the spending that we're seeing and the concerns in the marketplace. Well, Subadra, this has been great. I always appreciate your thoughts. And with that, Michael, I'd like to kick it back to you.
Yeah, Subadra, thank you so much, and Greg, thank you. I actually had a question or two, but I think time's going to keep me out of the game today, which is unfortunate, but it's better that you and Subadra kick around the important items. So Subadra, again, 3 times, that's fantastic. Hopefully we'll have you here for a 4th sooner than later. We are most grateful. Greg, always, this is fantastic. This is a tradition like no other that we have here, and I enjoy it always. And for any of our clients, as the Fed and rates and liquidity stay front and center, Greg has been very active and very busy on client calls, and he will continue to make himself readily available. I wish everyone a great day. Thank you very much.